Welcome. Before we begin, I want to set expectations. This is not a pitch about a new cryptocurrency. This is not a white paper walkthrough. This is a presentation about the first asset in history whose price trajectory is mathematically deterministic. Every other asset you have ever owned, stocks, bonds, gold, Bitcoin, real estate, follows a random walk. You model probabilities. You estimate ranges. You hope. Save is different. Save follows a hyperbolic curve, not because we designed it to be clever, but because the smart contracts that govern it make any other outcome impossible. The floor can only go up. The only variable is speed. Over the next 24 slides, I will show you the problem we are solving, the architecture that solves it, the proof that it works, and the opportunity to participate. Everything I'm about to show you is backed by real data, real code, and real mathematics. Nothing requires belief. Everything requires only arithmetic. So, look at the data on this slide. What you're seeing is not an edge case. This is normal operating procedure of the global financial system. Governments freeze accounts when they disagree with your politics. Payment processors hold your money for 6 months because an algorithm flagged your transaction. Entire nations get cut off from the banking system overnight, like the recent example of Russia. The fundamental assumption most people carry that the money in the bank account belongs to them is false. You do not own your own money. You have permission to use it, and that permission can be revoked by any number of institutions at any time for any reason with no due process. This is not a theoretical risk. The numbers on the slide represent a real people who woke up one morning and discovered that their life savings had been frozen by someone they never met. The question is not whether this will happen to you. The question is whether you want your wealth stored in a system where it can. So, this slide shows what happens to the money that does not get frozen. It evaporates slowly, invisibly, and by design. Every central bank on earth has an explicit mandate to debase your savings. They call it inflation targeting. What it actually means is that your purchasing power is being systematically destroyed at a rate of 2 to 5% per year compounding. The reason this theft is silent is that your bank balance stays the same. You see the same number, but that number buys less every year. Over 2 decades, $100 become $58 of real purchasing power. You lost 42% of your wealth while your statement showed no change. This is not a failure of the monetary system. This is the monetary system working exactly as intended. Central banks need inflation to service government debt. Your savings are the fuel they burn. The question for any serious investor is, why would you store wealth in a unit of account that is explicitly designed to lose value? So your money can be frozen and it is losing value. But it gets worse. Every transaction you make is watched, recorded, scored, and sold. Your bank shares your data with thousands of third parties. Your credit card company knows what you buy, where you buy it, and when. Governments around the world are now building central bank digital currencies, programmable money that allows them to monitor every transaction, in real time, set expiration dates on your cash, and restrict what you can purchase. This is not a dystopian fantasy. China's social credit system already links financial access to behavior scores. More than 130 countries are exploring the same technology. The combination of inflation and surveillance creates uniquely hostile environment for wealth preservation. Your money is simultaneously shrinking and visible. You're losing purchasing power inside the glass house where every movement is tracked. The traditional financial system offers you a choice between losing value quietly or losing privacy entirely. Flat protocol rejects that choice. So, this is where the solution begins. What you're looking at is the simplest possible comparison. What happened to your purchasing power depending on where you held your cash? Every major fiat currency on this chart lost value. Every single one. The dollar, euro, pound, yen, all negative. Flat is the only one that went up. And it did not just keep pace with inflation, it outperformed it. The reason this matters is not academic. If you are a business holding working capital, you are a family saving for a home, if you are a treasury department managing reserves, the currency you denominate in is costing you money every single day. Flat eliminates that cost. It is pegged not to a static dollar, but to consumer price index. One unit of flat today buys the same basket of goods in 5 years, in 10 years, and even in 20 years. That is not a promise. It is a mathematical property of the peg mechanism. And notice the volatility and the risk metrics on the slide. This is not a volatile crypto asset. This is the most stable store of value ever constructed with a volatility of just 0.22%. So this slide describes what flat actually is in plain terms. It is cash that you control, not your bank, not your government, not your payment processor, you. It is private. Your transactions are shielded by zero knowledge proofs, meaning the network can verify that the transaction is valid without knowing who sent it, who received it, or how much was transferred. It is inflation proof. The peg adjusts upwards with CPI, so your purchasing power is preserved by design. It is permissionless. No one can freeze it, restrict it, or confiscate it. It is borderless and it moves anywhere in the world in seconds at near zero cost without intermediaries taking a cut. And it is censorship resistant. No government, corporation, or individual can prevent you from using it. These are not features, these are properties. They're embedded in the smart contract code, which is immutable and has no admin keys. No one, including the team that built it, can change how flat works after deployment. The code is the law, and the law says your money is yours. So now here is where flat protocol diverges from every other crypto project you have seen. Most tokens have no revenue. They have ecosystems, communities, and governance, but no actual income. Flat protocol generates revenue in every market condition. In bull markets, the demand for flat exceeds the peg, and the engine mints new flat, sells it above the peg, and captures the premium as revenue. In bear markets, the flat trades below the peg, the engine buys it back at a discount. The difference between the discounted purchase price and the peg value is captured as reserves. This volatility arbitrage, and it works in both directions. The revenue is then split through the flywheel. 40% buys RISE tokens and locks them permanently in the vault. 30% builds liquidity in the flat pool, and 30% builds liquidity in the same pool. Every cent of revenue is converted into permanent value. Nothing is extracted. Nothing goes to founders. Nothing leaks. This is a closed loop engine that converts market activity into floor appreciation for safe holders. So I want you to think about Tether for a moment. Tether is arguably the most profitable company per employee in the history of capitalism. They take your dollars, invest them in treasuries, earn billions in yield, and give you back a token worth exactly $1. You get zero yield. They keep everything. You cannot buy equity in Tether. You cannot participate in the profits. You are the product, not the shareholder. Now look at Flat Protocol. Same business model, stablecoin issuance backed by productive reserves, but the revenue does not go to founders. It flows through the flywheel and directly into the same vault. When you hold SAFE, you're holding equity in this revenue engine. Every flat transaction, every mint, every redemption, every arbitrage cycle, the profit accrues to you. This is the difference between Tether customer and being a flat protocol owner. The stablecoin market generates tens of billions in annual revenue. The question is whether you want to be on the side that pays it or the side that collects it. So RISE is the base layer of the entire protocol. Think of it as the raw equity. There will only ever be 425 million RISE tokens. No more can ever be minted. This is not a governance parameter that can be voted on. It is hard-coded into immutable bytecode. Now look at the allocation. 50% goes directly into the save vault at Genesis, locked permanently, never to return to circulation. 49% is held in the treasury as inventory for ghost mint sales. And only 1%, that is 4.25 million tokens, trades on open market. Distribution, this distribution is deliberate and it is most important design decision in the entire protocol. That 1% pool is the throat of singularity. Every time the flywheel generates revenue and buys RISE, it buys from this tiny pool. Every purchase drains it further. Every drain increases the price impact on the next purchase. The pool is designed to be consumed, and as it shrinks, the price of RISE follows a hyperbolic curve, not a linear growth, not exponential growth, but hyperbolic growth where the rate of acceleration itself accelerates. So, what is ghost mint? This is the first of the two black holes in the protocol. When you buy SAVE through ghost mint, you send ETH. 100% of that ETH goes into treasury reserves, not a portion, all of it. The protocol takes RISE from its inventory, deposits into the vault, and mints SAVE and gives it to you. So your ETH is rebalanced into a diversified reserve portfolio. Here is what makes this black hole. There is no redemption function. You cannot go back to the ghost mint and exchange your save for ETH. The ETH you sent in it is permanently absorbed into the treasury. It will never leave. It is converted into reserve assets that back every safe holder's position and generate carry income that flows through and the flywheel forever. Every new investor who enters through Ghost Mint does not dilute existing holders. They fortify them. Their capital becomes part of the reserve base that protects everyone. Ghost Mint also has a built-in price cap. It prices new save at a maximum of the current price and 1.1 times the net asset value. This means new issuance can never dilute below 10% premium to book value. And this logic is coded into the smart contracts. So, what do you get when you buy SAVE? This is what you're actually buying. SAVE is a ERC4626 vault token, a standard that represents your proportional share of everything inside the vault. The math is simple. NAV equals the total rise in the vault divided by the total SAVE shares outstanding. Here is why this can only go up. The numerator, rise in the vault, increases every time the flywheel deposits tokens. It can never decrease because there is no withdrawal function. The denominator, save shares, is a fixed at issuance. No new shares are created except through ghost mint, which adds proportional value. So you have a fraction where top number grows and the bottom number stays the same. The result is monotonically increasing exchange rate. This is not a projection or a model, it is mathematical identity. The vault cannot lose value in rise terms because rise follows a hyperbolic price curve in ETH terms. The dollar value of each saved token accelerates over time. This is what I mean by deterministic. The direction is not in question. It is a property of arithmetic. So, this slide explains one of the most elegant mechanisms in the protocol, the LP tokens as batteries. The flywheel sends 30% of revenue to flat ETH pool and 30% to save ETH pool. These are not temporary liquidity incentives. They are permanent protocol-owned positions that can never be withdrawn. In bull markets, the flywheel is charging the batteries, adding more liquidity, deepening the pools, making the protocol more resilient. In bear markets, the batteries discharge. When panic sellers dump into the pool, they are selling into protocol-owned liquidity. The protocol earns trading fees from the very event that destroys other tokens. This is the fundamental difference between rented liquidity and protocol-owned liquidity. Rented liquidity is the kind that comes from yield-forming incentives, and it flees at the first sign of trouble. It disappears exactly when you need it most. Protocol-owned liquidity stays. It does not care about sentiment. It does not have emotions. It sits in the pool and collects fees from every trade, bull or bear, forever. The fees recycle back through the flywheel, creating another layer of compound. This is the NAV fractal, the mechanism that makes SAVE a deterministic asset. Look at the progression on the side. The floor starts at $1 and it only goes up. It has never decreased in 3 years of backtesting against real market data. Not once. Not during crypto winter, not during bank collapse, not during rate hikes. The reason it cannot decrease is architectural, not circumstantial. The vault only receives deposits. It never makes withdrawals. The flywheel only buys rise. It never sells. The ghost mint only issues at a premium to NAV. It never issues at a discount. Every mechanism in the protocol is designed to push the floor higher, and no mechanism exists to push it lower. This is what separates SAFE from every other asset. Gold can lose value if new deposits are discovered. Stocks can lose value if earnings decline. Bitcoin can lose value if sentiment shifts. SAFE cannot lose book value because the code does not contain a function that would allow it. The floor is sovereign. It answers to no one and nothing except the mathematics of the vault. So this is the slide that answers the most frequently asked question by every crypto investor. You have seen the crashes. You have held tokens that went to zero while the team tweeted, "We are building." You have watched liquidity evaporate overnight. So the question is fair. Who buys your bags when the market turns? The answer is the protocol does. And it does so through a graduated 4-tier defense system that gets more aggressive as the discount deepens. At a mild discount, light buying. At a moderate discount, heavier buying. At severe discount, aggressive buying plus permanent supply burns. Meaning the protocol does not just buy safe, it destroys it, reducing the denominator and increasing the NAV for every remaining holder. At an extreme discount, maximum intervention with full force of treasury. The defense budget is 10% of liquid reserves per day, sustainable for over 10 consecutive days of maximum tier buy. And above all, this sits a ghost mint clamp. New issuance stops entirely when the market price falls below 1.1 times the NAV, forcing all demand to the open market. The protocol does not hope the market recovers. It mechanically forces recovery. Now we move from architecture to evidence. Everything I have described so far, the vault, the flywheel, the black holes, the defense system, these are mechanisms. The slide shows what those mechanisms actually produced when fed 3 years of real world data. Real CPIU numbers from Bureau of Labor Statistics, real market prices, real volatility, no simulations, no Monte Carlo simulations, no optimistic assumptions. The backtest ran the smart contract logic against actual market conditions, and the result is what you see on this chart. While every traditional benchmark delivered modest returns with significant drawdowns, SAVE compounded at a rate that makes it look like it belongs on a different chart entirely. And the critical insight is this: these returns are not the product of speculation or momentum. They are mechanical output of a closed loop system. The flywheel bought rise, the vault absorbed it, the floor ratcheted up, the hyperbolic curve did what the hyperbolic curves do. The returns are consequence of the architecture, which means they're not historical anomalies. They are structural properties. And SAVE has returned 68.1% CAGR per year in this 3-year backtested time. Risk-adjusted returns are how professional allocators actually evaluate investments. Raw returns are meaningless without understanding the risk taken to achieve them. A fund that returns 50% are meaningless without understanding the risk taken to achieve them. A fund that returns 50% but has 80% drawdown is not a good investment. It is a roller coaster that most people will exit at the bottom. What this slide shows you is that SAVE does not just outperform on returns, It outperforms on the ratio of return to risk by a factor that should not exist. Warren Buffett has spent 60 years building the greatest track record in investment history, and his lifetime risk adjusted performance is a fraction of what SAVE produced in 3 years. Bitcoin, which many consider best performing asset of the last decade, delivered returns with catastrophic drawdowns that would cause any institutional allocator to reject it immediately. SAVE delivered high returns with a fraction of volatility. The maximum drawdown was so small that most traditional portfolios experience worse in normal quarter. This is what a deterministic asset looks like on the risk return scale scatter plot. It sits alone in the upper left corner where nothing else has ever been. And the Sharpe ratio is, when compared to any other asset, it is spectacular, which is at 3.51. So this slide translates the percentages into dollars because percentages are abstract and dollars are real. If you had put $10,000 into SAVE at the start of the backtest period, you would have over 4 times your money 3 years later. The same $10,000 in S&P 500, which had historically a strong run, would not even have doubled. Bitcoin, despite all the headlines and all the hype, would have barely outperformed a savings account in the same exact time period. And it would have given you $500 of interest, and now the savings account would have given you $500 of interest while inflation took $2,000 of purchasing power, a net loss dressed up as a gain. The reason I show this comparison is not to cherry pick a favorable period. It is to demonstrate what happens when an asset has a floor that only goes up. Compounding works differently when you never give back the gains. SAVE never gave back gains in the backtest, not once. That is not luck, that is architecture. Now, this slide talks about the crypto graveyard. This is a slide that should make you angry, not at me, at the industry. Look at these tokens. These are not obscure projects. These are top 20 tokens by market capitalization. Billions of dollars invested, millions of people who believe, and 13 out of 20 lost money. Some lost almost everything. The reason is not that crypto is inherently broken. The reason is that these tokens had no revenue, no book value, no treasury, and no floor. They are pure speculation. Price went up because people bought, price went down because people sold, and there is nothing underneath to stop the fall. SAVE is the antithesis of this. It has revenue from the engine, it has book value from the vault, it has treasury backing every token. It has a floor that mechanically ratchets upwards. It has a defense system that buys during crashes. The crypto graveyard is full of tokens that promise the future and deliver nothing. SAVE promises arithmetic and delivers exactly that. The difference is not marketing, it is architecture. And SAVE achieved this 332% return just with a minus 8% maximum drawdown. So from peak to the trough, it's only dropped by 8%. Now let's talk about scale, because the architecture only matters if there is demand to feed it. And here we are sitting on $150 trillion opportunity. The global payments market is enormous. Cross-border business payments alone represent tens of trillions of dollars annually. Remittances add hundreds of billions of dollars more, with workers in developing countries losing 5 to 7% of every transfer to intermediary fees. The stablecoin market has already proven that demand exists for digital dollars. Hundreds of billions in circulation and growing rapidly. Flat is not creating a new market. It is offering a superior product in a market that already exists. An inflation-proof stablecoin with built-in privacy is strictly better than USDT or USDC for any use case. Savings, payments, remittances, and treasury management. The numbers on this slide show what happens if flat captures even a tiny fraction of this existing volume. The revenues flow through the flywheel feeds the vault increases the floor, and save appreciates. The scale of the opportunity is not speculative. The market exists today. The only question is execution. So here is where the future meets the present. The next Here we want to talk about where is the next wave of demand coming from. Autonomous AI agents are already operating in wild, booking flights, executing trades, managing supply chains, negotiating contracts. By 2028, a third of enterprise software will include agentic AI. These agents need money, not bank accounts. They cannot open bank accounts, not credit cards. They cannot pass identity verification. They need programmable, stable, private digital currency that settles instantly without human approval. Flat is built for exactly for this use case. Every agent transaction generates a fee. Every fee flows through the flywheel. Every flywheel cycle increases the floor of sale. The machine economy is coming, whether we are ready or not. The question is which currency these machines will use. Flat is designed to be the answer, stable enough for settlement, private enough for competitive operations, programmable enough for autonomous execution, and requiring no human intermediary at any point in the transaction chain. When billions of agents are transacting every second, the protocol that provides their reserve currency will generate revenue at scale that dwarfs anything in traditional finance. This is the most important slide in the deck. Not the return slide, not the tether comparison, this one. Because any sophisticated investor knows that the bull cases are easy to construct. The question is that separates serious capital from speculative capital is what happens when everything goes wrong? What if flat gets zero adoption? What if no one uses stablecoin? What if market crashes and stays crashed? The answer is on the slide. The answer is the protocol still works. The treasury holds productive reserve assets, specifically GOM with cooler loans carry, which earns spread between borrowing costs and yield regardless of market conditions. Even with zero flat adoption, zero trading volume, and zero new ghost mint purchases, the passive carry income will generate revenue. That revenue still flows through the flywheel. The flywheel still buys rise, the rise still gets locked into the vault, the floor still rises. Worst case is not zero. Worst case is still positive. The floor still goes up, just more slowly. This is what a deterministic asset means in practice. Even the worst case scenario has a known positive outcome. So why now? Timing matters. Three structural shifts are converging right now that makes this optimal moment to enter. First, traditional 60-40 portfolios are dying. Bonds and equities are now positively correlated, which means diversification benefit that justified 60-40 for decades has evaporated. Allocators are desperately searching for uncorrelated returns streams with downside protection. SAVE is exactly that, a deterministic floor with hyperbolic upside and near zero correlation to traditional markets. Second, a central bank digital currencies are accelerating. Every major economy is building a surveillance money. The demand for private, censorship-resistant alternatives will explode as CBDCs roll out. FLAT is positioned to capture that demand. Third, the hollow asset reckoning is underway. Crypto graveyard you saw earlier is still being filled. Investors are learning painfully that tokens without revenue, without book value, without flows are worthless in their market. The flight to quality in crypto has begun, and SAVE is the high quality digital asset ever constructed. These three forces are converging now, not next year, now. So, what are we offering? Here is the opportunity: 100 million SAVE tokens at $1 each. $100 million is the total rise. And look at where the money goes. The largest allocation flows directly into the liquidity provision, which is 40%, and treasury reserves. This means 40 cents of every dollar you invest goes directly into reserves that back your own token and the liquidity pools that protect your exit. Your money is not disappearing into a corporate treasury to pay salaries and rent. It is building the fortress that protects your investment. 30% goes to marketing and ecosystem growth. This is the fuel for flat adoption, which is the engine that drives flywheel revenue, which is what makes your save appreciate. 20% of the funds continues research and development. 10% covers operational expenses. The incentive alignment is total. The team succeeds only if flat adoption grows, which only happens if the product works, which directly increases the value of save. There is no scenario where the team wins and the investors lose. The architecture does not permit it. So, if what you have seen today makes sense to you, if you understand the deterministic asset with hyperbolic price trajectory, backed by productive reserves, defended by a four-tier buyback system, and generating revenue in every market condition is something that should exist in your portfolio, then the next step is simple. The entry price is $1. The floor has never gone down in 3 years of real data. The worst case still produces positive returns. The best case produced 68% annual compounding return. 68%. The protocol buys your bags in a bear market. The reserves are productive from day one. The smart contracts are immutable. No admin keys, no human override, no governance vote that can change the math. You're not buying a promise. You're buying arithmetic. The contact information is on the screen. If you are interested in purchasing SAVE tokens, send an email to team@flat.cash. Thank you for listening.